Homework assignment, try it, 21-2, contribution margin. So a furniture manufacturer specializes in wood tables. The tables sell for $100, so the price of a table is $100. Our sales revenue per table is $100, and incurs $40 per table in variable costs. Now remember, a variable cost is, as the production of the tables increases, variable costs will increase. And as production of wood tables decreases, the variable cost will also decrease. And then the company has $6,000 in fixed costs per month. A fixed cost means that no matter how many tables they make, they're going to have $6,000 of these costs per month. It might be like the rent and other costs that don't change when production levels change. So our first task is to prepare a contribution margin income statement for 1 month if the company sells 200 tables. So going back to our slides, here are the two formats of the income statement. In previous chapters, we always use the traditional income statement, which is just sales revenue minus cost of goods sold, gives us our gross profit. And then we subtract our period costs, which are selling and admin expenses, which gives us our operating income. And product costs, remember, are the costs to produce or to purchase the product that we are going to be selling. And operating income is just the income before other revenues and expenses, such as interest revenue and interest expense, and also before income tax expense. So this is what we're used to using the traditional income statement. This is what is required by GAAP, General Accepted Accounting Principles. This is the format that you'll see for publicly released income statements. However, managerial accountants use this contribution margin inside the company. So internal users oftentimes use this contribution margin income statement, which is net sales revenue minus our variable costs, which gives us our contribution margin, and then we subtract our fixed costs, which gives us our operating income. So these are two different ways, two different formats to arrive at the same operating income. But for managerial accounting, this format is more useful. So what is contribution margin? What's the definition of that? Well, let's go back to our slides too. Another slide, we have our contribution margin formulas. So here's our CVP analysis toolbox, cost, volume, profit. And we've got 3 different formulas. So contribution margin is right here, sales revenue minus variable costs. So once you take your sales revenue, subtract your variable costs, that means it's the amount of revenue left over after the variable costs are covered. In other words, it's the leftover amount that contributes to covering fixed costs. And once those costs are covered, it contributes to profit. We also have unit contribution margin, which is probably easier for most students to understand. Unit contribution margin is the same as contribution margin, but it's just per unit. So sometimes this is called contribution margin per unit, which is sales revenue per unit minus variable cost per unit. So let's look at this example over here from our slides. Remember Ted's tablets? He sold tablets for $500 each, and the tablets cost him $400 to make each. So to get our unit contribution margin, we take our sales revenue per unit, $500, minus variable cost per unit, $400. So the contribution margin per unit is $100. So that means every time Ted sells a tablet, he has $100 of revenue left over after the variable costs are covered. In other words, the $100 is a leftover amount after a sale that contributes to covering Ted's fixed costs. And if he covers those fixed costs, then that amount contributes to profit. So let's get back to our homework assignment. So we're going to do the contribution margin income statement, which is this formula. So we're going to have net sales revenue minus variable costs. Net sales revenue minus our variable costs equals our contribution minus fixed costs. Contribution margin minus our fixed costs gives us our operating income. There it is. So now let's do the number crunching. Sales revenue. So we sold 200 tables. Remember, this company sells wood tables. The tables sell for $100 each. So $100 times 200 gives us $20,000 in net sales revenue. Then we have our variable costs, which are $40 per table times 200 tables gives us $8,000 of variable costs. So contribution margin is just sales revenue, $20,000 minus variable costs of $8,000. So we have $12,000 of contribution margin. That means, once again, it's the amount of revenue left over after variable costs are covered. In other words, it's the leftover amount that contributes to covering fixed costs. And once those fixed costs are covered, it contributes to profit. So now we're going to subtract our fixed costs. Our fixed costs are $6,000. So operating income is $12,000 minus $6,000, which gives us $6,000 of operating income. Next question, what is the total contribution margin for the month if they sell 200 tablets? So we're still talking about this scenario here. And our contribution margin, we already calculated, $12,000. Next, what is the unit contribution margin? So remember, unit contribution margin is the same as saying, what's the contribution margin per unit? So unit contribution margin formula is here. Sales revenue per unit minus variable cost per unit. So sales revenue per unit minus the variable cost per unit gives us our unit contribution margin, also called contribution margin per unit. So our net sales revenue per unit is $100 minus our variable cost of $40 gives us $60. Now notice this, 100 minus 40 equals $60 of contribution margin per unit. So what that $60 means is every time this furniture manufacturer sells a table, each sale represents, or each sale generates $60 of contribution margin, which can then be used to cover our fixed costs. And once our fixed costs are covered, then it goes to generating profit. So then last, we've got, what is the contribution margin ratio? So this is a percentage. So the contribution margin ratio is right here. It's the contribution margin divided by sales revenue. So it's contribution margin divided by sales revenue, or net sales revenue. They use those interchangeably pretty much. So the first part of the formula is contribution margin, which we get from right here, 12,000. Copy, paste. Divided by net sales revenue, which is right here. Copy, paste. And then they want you to divide 12,000 by 20,000 and then convert it to a percentage. So 12,000 divided by 20,000 gives us 0.6. To convert it to a percentage, we multiply by 100 and we get 60%.